Hey traders, Tom Gentile here, coming off another weekend where we saw more limit down moves happening overnight, and of course into Monday we saw that pop as we await a stimulus package. I mean, the pattern that we're seeing here just seems to be we got this constant downtrend. Anytime we get a bit of good news, we get a violent pop in the market followed by more downtrend. So I kind of expect that to continue, but I wanted to give you an update on the coronavirus as I see it, as well as its impacts. Not only financial impacts, but I want to show you a couple other things. I want you to start thinking about the patterns that are happening and how we can best, number one, save as much money as possible, but also number two, profit from what's going to be continued volatility in the marketplace. So let's get started. First, I want to talk about the past, present, and future. We'll do a quick description of this. We'll talk about the impacts of the virus, what I believe the future is going to hold, and then finally trading for the short term and investing for the long term. So let's go ahead and get started. So what exactly is a coronavirus? We didn't just name this coronavirus. Coronavirus is a general term that talks about related viruses that cause disease in mammals and birds. And then that gets transmitted to humans, which causes respiratory tract infections. And they can be mild, but they can also be deadly. And so this is information that I pulled actually from Wikipedia to show you and to give everyone a general term of what coronavirus is. An update, hundreds of thousands now infected, all right, as well as tens of thousands that have died from this disease. And while the number of deaths to infected go down, and I think they're going to continue to go down, down from, we started off with 10%, and now we're down around the areas of, into the small percentages, less than 3% now. And I think that number is going to continue to go down. What you're going to see is this really kind of the world has kind of come to a halt now. And this is not anything where we're just going to sit some jumper cables on. It's going to start right up again. I think it's going to take time. And as we move forward and we look at, confirmed cases, we're still, if I were to move this way real quick, we're still on a trajectory where we're growing exponentially. And the problem with growing exponentially is that's what's causing the fear around the world, financially, socially, economically. And until that curve starts to tail off and flatten, or even look like it's going to flatten, we're going to continue to see fear around the world. Impacts. Let's talk about impacts. Political impacts. Now, political impacts could be positive and negative. On the positive side, there is this sense of unity as we're all now fighting a common enemy. Everyone around the world is now facing this enemy. And so we're not bickering about normal things that we bicker about, whether you're a Democrat, Republican, independent, what sex you are, race you are, whatever differences we have right now, those have all been put aside. The negative on this is that as any crisis lingers on, we go from patriotism and unity to all of a sudden there becomes breakdown, political breakdown, and social breakdown, where we just start getting frustrated with government's lack of follow-through. I wanted to take you back on two recent scenarios. Number one, 9/11. Swift reaction, and it really garnished a lot of patriotism in the U.S., all right? Now take a look at what happened just a few years later with the 2008 financial crisis. All right, that was completely different. And these were two different scenarios that happened under one administration. The first one, the administration got reelected. The second one, the administration was changed over. And so you can see the political impacts that happened between 2001 and 2008, both on the positive side and on the negative side. Social impacts. I think work and play from home is going to become the new norm. You take a look at companies like Zoom, which makes webinars and home meetings possible. This thing's going crazy right now, and I do think it's overbought, but I also think that there are people now that are working from home, and some of them can't wait to get out of the house. But some of them are saying, hey, I kind of like this. Less gas, less time to get to the office and get home, more time with my friends and my family. And so I think working from home is going to become the new normal for a lot of people. Now, what does that do to the commercial real estate business? I don't know yet. Some will fail, some will flourish from that. But I'm just telling you, think about the changes that are going to happen longer than the next couple of months. Next, digital media, like I said, is going to rule online, and that's everything from meetings and webinars to even homeschooling and education. For instance, the state of Florida has been doing online education for years now, but there are a lot of states that do not, that will be doing this in the future, just to continue to keep safety at bay, safety a main priority. And so think about that. Here's something else to think about. Voting changes, all right? I imagine the mail-in voting, all right, where people actually fill out a piece of paper and do an early mail-in, is going to triple in size this year, if not more. But I also see now that we could jump to online voting much quicker than anyone anticipated coming out of this virus. Economic impacts. Unemployment, last month was at 3%. I don't say it's going to 20% right away, but within weeks, we're going to see that number pop up. April, yes. May, even more. And the reason why is you're going to see, first, the impact that the shut-ins are having. The next impact is going to be after Q1 earnings. And then we're going to start to see some, and even Q2 earnings, we're going to see some resets as well as far as unemployment. Healthcare is going to go tech. That means teledoc is going to become the norm, where you're able to have conversations with your doctor and maybe even have your pharmacy products shipped to you. These are some ideas that are being tossed around. All right. Finally, technology is going to hit a new high because, again, all the things I just talked about are possible through technology. Right? Financial impacts, and this is what you're really waiting for. So the initial stock market the initial shock, may be over soon, but I don't think the bottom is in yet, because what's happening is, like I said, these patterns are creating what we call lower highs and lower lows. We get this move to the downside, and then we get a quick pop-up, and then another move to new lows and a quick pop-up. And the stimulus might be the next thing that causes the quick pop-up before we drop down even lower. The bounces are fast and furious. The moves to the bottoms, they're fast too, but they seem to be more orderly at this point. The bottom will come, but it's going to take some time. So really, how do you trade this? All right, a couple things that I've talked about now. Step one, take less risk in your strategy. All right, just take less risk. That way you're able to approach this with a calmer attitude. Number two, look at what's going up in a down market. Well, let's see what goes up in a down market. There's certain stocks, grocery stocks that are going up. Zoom is going up, although I think that one's overdone. But what else goes up in a down market? Put options, all right? Put spreads. You're going to have to find some that actually have some liquidity, means the bid-offer spreads are pretty close together. The smaller dollar stocks do offer that. And I want to make sure you realize that. The big stocks right now, the bids and the asks are very, very wide. So they're not only are they expensive, but they're risky as well. And then finally, exploiting volatility. And exploiting volatility means this. Options are very expensive right now, so you need to keep that in mind. A good option trader likes to go against the grain. While some folks are buying options that are expensive, smart option traders are selling options. But they're doing so while hedging risk. For instance, credit spreads. That's one way you can do that. And I would urge you, if you do not know what a credit spread is, you need to find out. You need to get online, look at my information that I have online about credit spreads. They are not as hard as you might think they are to understand. All right, so rules-based trading, we can look at short-term, we can look at long-term investing. Let's look at short-term trading first. So stop being a fundamental or technical trader. When the VIX is as high as it is, you got to throw all that out. All right? You don't just buy calls or puts. They're 10 times more expensive now than they were a month ago. What you want to do is you want to become a volatility trader. There are 3 ways to do this. Number 1, let's take a look at volatility by history. This is an example of Delta Airlines. And look what's happened. It's gone from 60 down to the low 20s. All right, so it's dropped 2/3 of its price in the last month. But the red line here is the options volatility, which was low back when this all started happening. And it went, I'm going to tell you, the volatility itself went up over 10 times. That means the options in Delta are trading at 10 times the volume. So the one thing I can see right now is maybe we ought to look at some selling strategies in Delta Airlines. The next chart I want to show you is volatility by expiration. So what I've noticed, and any good options trader can see this too, is that the short-term options, these are the ones that expire in between 7 and 30 days, are much more expensive in volatility than the 60-day options and the 90-day options, all right? And then finally, I want to show you the third chart is volatility by skew. Now, what skew is we actually look at a volatility number based on strike price. All right, so I can look here on the vertical and I can look here on the horizontal, and I can see that this is a very high implied volatility when comparing it to this strike price, which is a lower, still high, but a lower IV. So what we can do is we can look at skews between strike prices, and these are Delta strike prices on Delta Airlines, all right? And so again, we can take a look at these and come up with some ideas with volatility on how we can exploit it. Number one, volatility by history, simply buy low and sell high. The time to buy options on Delta was a month ago. The time to sell options on Delta is right now. Number two, volatility by expiration. You can buy the longer term options and sell the shorter term options. That's referred to as a time spread or a calendar spread. All right, so you got to have software that can help you gauge what's expensive and what's cheap, so that way you can hedge off the high volatility options with the low. And then finally, volatility by skew. Buying lower volatility strikes and selling higher volatility strikes within the same asset. So for instance, with Delta Airlines, right now on the put side, you buy the puts that are closer to the stock to Delta stock price, and you sell the out-of-the-money puts because the out-of-the-money puts have a much higher implied volatility. There's a hedge built in there. All right? Now, rules for long-term investing is we're going to get a bottom soon. All right? It's going to happen. And then off that bottom, it's going to take some time. All right, I'm seeing projections all the way out to be in the fourth quarter before we actually see some real robust movement back up to the upside. And so you got to think about this. Here's my rough support points. 15 to 18K, we're almost at 18 right now. S&P 500, 18 to 2,000, and NASDAQ 4 to 5,000. Right now, the NASDAQ number, I would tend to be more on the 5,000 for sure, because the NASDAQ is holding up much better. And then I also believe that the S&P 500 is going to be more around the 2,000. The Dow, we could drop into the 15K level. Start small, but start often. All right, we talk about this a lot. Trade small, trade often, and that way you're able to really take the emotion out of your trading. Leaps are a particular type of option. It's an option that has 9 months or more to expiration. There are leaps out there that have as much as 2.5 years to expiration, and that gives you the right to buy that asset, and you have 2.5 years on that option, so you got plenty of time to be right. So this is something you want to look at, but I'm going to mention this to you too. Leaps, because of all that time, they're not cheap right now. They're expensive. So the best way you can position yourself in long-term investing with options is by utilizing what we call out-of-the-money leap spreads. They make the most sense. They're the cheapest, have the least amount of risk. They have a great break-even compared to buying the leap on its own. And this puts you in a situation where you're coming in and you're anticipating looking for that bottom and having plenty of time for that bottom to actually occur and the recovery to start as well. Hey guys, thanks for watching my coronavirus update. I look forward to sharing more videos with you in the future. Bye now.